eToro came out as number one for me, and then I started investing on eToro. And then as my investments on eToro were doing very well, some people started copying my investments on eToro. Then more and more people started copying me. My friends and family members started copying me. And then eventually in 2018, I decided to quit management consulting to focus only on managing my investment portfolio on eToro. And then 1 year later, I was the most copied on the platform. And here almost 11 years later, still number one on the platform. And so if you already know that you will need the money in 2 years for something, then probably copying me, which means investing in stocks, is not the right decision. I would generally say you should have at least a 5-year horizon.
Hello, and welcome to the Achieving Alpha podcast. My name is Stephen, and I am the host of the show. Today, I'm pleased to be joined by Jeppe Kirk Bonde, who is the world's most copied social investor on the eToro platform. Jeppe has over 23,700 retail investors copying his portfolio, as well as managing up to $77 million of people's money. Jeppe has achieved a really great performance over his 11 years on the platform, and he is currently averaging 24% per year. Welcome to the podcast, Jeppe. It's really great to have you on.
Thank you, Steven. Thank you for having me.
Yeah. How's everything in Dubai?
I'm loving it. It's very good, although it's starting to get too hot, of course.
Yes. It's that time of the year. Great. Okay, thanks for coming on. I wanted to, first of all, get an introduction from you. I would like to hear a little bit more about how you got into investing and just some more information about your career.
All the way back growing up, I thought I would go into politics. So I did my bachelor's degree in political science. Then I thought, okay, doing that, I thought the power was in finance. So I did my master's degree in finance instead. And then I started work as a management consultant. And then I was sent to advise large tech companies and banks and other such companies about primarily valuation, to calculate how much companies are worth. Then as I was doing that, I was making more money than I was spending. So I wanted to invest some of my money. And then I looked initially at what does our company pension fund offer, what does my bank offer, and I was very unimpressed with what they were offering. My pension fund, for instance, they were only investing in Danish companies, in Danish government bonds, Danish real estate projects, and I thought, okay, so that's all Denmark. They've put no effort into diversification, so it would be very easy to do better than that, at least, especially given their fees. Then I decided, okay, I'm gonna do this on my own, and then I made a spreadsheet of all the different investment platforms available. What products are available? What's the website like? What's the app like? What are the fees like? And so forth. And then I weighted all those factors and scored all the different platforms and then ranked them. And eToro came out as number one for me. And then I started investing on eToro. And then as my investments on eToro were doing very well, some people started copying my investments on eToro. Then more and more people started copying me. My friends and family members started copying me. And then eventually in 2018, I decided to quit management consulting to focus only on managing my investment portfolio on eToro. And then 1 year later, I was the most copied on the platform. And here almost 11 years later, still number one on the platform. And then I hired some people to help me. Today I just have one assistant, and I spent most of my career in London. Now I live in Dubai, and that's the grand story.
Wow, that's some journey you've had, Jeppe, over 10 years. Congratulations on your 10-year anniversary as well this year. It's a great achievement. Were you expecting to have such success in a relatively short period of time?
I think I've always dabbled in many different things, so I always knew one thing or the other would work out really well. When I started out investing, the companies that I picked were all very good, and the ones I've added along the way have generally managed, like, of the companies that eventually became the Max 7, I did pick out all 7 of them, despite not picking that many tech companies and so forth. And when I started out, I had in my mind a vision of what the future would be like, and we are very much now living in that future. So I had an idea that, like, these companies are going to do really well and people are really not appreciating it, and so I'm making amazing deals by buying these companies now. And that's how I feel as well with companies I have in the portfolio as well now. Like, people are just not thinking 10 years ahead. They're really just, last quarter, how many, really, people cannot really get ahead. and a little bit into the future, and then yeah. So then you never know that's gonna go well, but I'm very happy when I make the investment. Like that's almost when I celebrate, because that's the point where I've completed my analysis. Like I had discovered a company here that's worth a lot based off of this hypothesis than what I'm paying for it. So by clicking buy right now, I'm buying something that's worth a lot at a very low price. So that's when I'm making the deal. That it goes up a lot later, that's just an after effect. The real treasure hunt is for that moment of buying something at a way too cheap price.
Yes, it does give you a big buzz. So, for the listeners that maybe aren't familiar with the eToro platform and the Popular Investor Program, could you just explain a little bit about what copy trading actually is and the process of copy trading and what it does?
Yeah, so eToro itself is a multi-asset broker, so people can use it either with a demo account or by depositing real money and invest in oil, Bitcoin, Apple, Microsoft, stocks from all over the world, all types of assets. And then you can click to buy on with whatever you want, but you can also copy other users. So if you are not sure whether you want to buy Apple or Microsoft, then you can either take all of the amount you put in or just a part of it and say, okay, I'm going to copy someone like me for that amount. And then when I click buy on Apple, then the copiers automatically also buy Apple at the exact same time. And then when I later sell that, they sell it, and then we're in the same boat. And so what many people do is they pick out like 2 or 3 different popular investors, and then to say, I'm going to copy Jeppe with 30%, and I'm going to copy Jay with 20%, and so forth, and then maybe pick out a few assets themselves as well. And then then just people copy year after year. Many people, they make it a habit to deposit money regularly, so they increase the amount they've put in themselves, and then that's the most common way of using it.
Yes. And I suppose because people are so busy in their everyday lives, it makes it really difficult for them to follow individual stocks, keep up with the market. So by copying a popular investor, it takes out a lot of the hard work behind investing, and you can invest in someone you trust.
Exactly.
Yeah. Okay. So on your investing experience and also on your personality, is there anything that kind of stands out for you and why you think that you might have been successful in the pursuit of investing? Is there some character traits that you hold or anything that makes you versed in investing?
I think I just spent my whole life doing research, and I just continue to spend all my time doing research. I'm very curious, so I want to understand how everything works down to the very granular detail. And then through my career, that's taken me to understand technology, politics, finance, and other sort of niche areas. And even as a management consultant, really my job was to just interview people in the companies, learn how what the company is really about, and spend 6 weeks really just reading and learning and asking questions until I knew as much as possible, and then make a quick PowerPoint presentation summarizing what I found. And in researching companies as well, I just research, and just what else do I feel like I'm not knowing? What more do I want to know? And then in the end, buying the right companies isn't that big a deal then, because I look at all these companies and I know them really well, and I have a I know their numbers and I know what their prospects are and I know their products and so forth. And then based off of that, I'm like, yeah, I want to have a little bit more of that and a little bit less of that. Or if I see something else, I'm like, yeah, I need to research more about this because clearly this is something that. So yeah, I think that's really, if there's been one key, it's my unquenchable curiosity.
Yeah. Okay. All right. And how do you go about researching stocks to put in your portfolio? What is your kind of daily process for investing and selection criteria?
Yeah, so I usually, when I start the day, I just do a quick news brief and check out some sort of grand numbers that are aggregates of a lot of numbers, just to get a major overview. And then if that doesn't trigger anything special, then I just go. Then I have a huge system with all things that I ever need to do in all of my life. All of them are scored with how much US dollars they're worth for me for this to get done. And then they're tagged with all sorts of different categories. And based on what day it is and all sorts of things, it'll just automatically structure what order I have to do things in. And then I just start from the top and then do that thing and then do the next thing and then do the next thing and then just continue. And then if it's a weekend day, it makes my list a little bit shorter. If it's that I just built that myself to make sure that I'm always working on the most important thing. And then there's always a lot of stuff that I know that I should know about that I don't know enough about, and then either reorganizing that or plowing through that and being like, I need to know more about that, and that. And then, of course, often when I'm researching one company, then as I'm researching that company, I notice that they have a really interesting supplier. Then I might be researching their supplier. But then in doing that, I talk to someone who works at that company. But in doing that, I learn something. And then suddenly you've loaded up on a lot of stuff. And then sometimes there can be a big new factor that's actually relevant for a lot of different companies. But if you go through that in detail in analyzing one company, you can reuse that knowledge then for when you are looking at other companies. And over the many years where I've built on my valuation models, when I many years ago invested in 11 years ago invested in a Meta, back then called Facebook, I didn't just learn about Facebook. I also learned about the concept of social media advertising. And then I was then able to use that to say, okay, what kind of companies are advertising on social media? How's that going to be? How much money can others make from being able to utilize this kind of advertising instead of? And so that didn't just help me invest in them; it also helped me in analyzing other companies. And effectively, every company has something that's unique about them. And if you find really what that is and dive deep into understand that, then you can apply that knowledge to all the other companies you value. And I just built that into one grand model that values all the different companies. And then on one week, I might be diving deep and optimize how much do I think companies are going to be paying in taxes in the far future in different countries, or it could be what I think will happen in case this technology comes at the same time as this technology in the future. And then based on all that, I value the companies, how much money will they make in different scenarios, how much is that then worth today, how is that compared to their enterprise value, and then I want to invest in companies that are worth a lot more based off of that than they cost today, that fit together in a total risk sensible way at my risk appetite. So I want to take some risk, but I don't want to take too much risk. And then if I'm not at that risk level, then I have to sort of evaluate if I need to make some changes to get to that target risk.
Yeah. Okay. And how do you go about portfolio allocation? So how do you decide what industries you invest in, what percentages in that industry, in that geographical region? How do you go about diversifying your portfolio as well as you can? And do you have any kind of rule-based method in there on how you allocate both percentage weighting and also the amount of risk involved in each allocation?
There are a lot of different factors that are all important and that each are with different levels of importance. So I aggregate all those up to make my decisions. I never work with any sort of like hard rules, like I must have exactly 20 investments, or I will allocate exactly 8% to this country, or something like that. I always find those rules are suboptimal. You're just setting up some artificial borders around stuff. I prefer to take all of the things that I think are important and then just weigh them up and multiply them out. Hypothetically, I don't want to have too much invested in a single company. But certainly there are scenarios where I would want to have that. So I don't need like a fixed rule to tell me that I will max have this invested in that company. Because in a certain situation where I wouldn't want to have that, then I wouldn't want to have that. And probably in most situations, the sort of normal risk calculation would just tell me to not have too much invested in a single company. And then I won't have that. But it doesn't get like a stand in as a fixed rule. And also I have a certain risk appetite. But hypothetically, if there was an opportunity, I thought, wow, this can really do so well. If it works out, even though it's a bit risky, maybe I would say, okay, it's worthwhile to take that risk. And then other times it's okay, here I feel like for only reducing my average weighted performance, I can almost keep that but massively reduce the risk, then I'll take that. So that's always a trade-off on multiple fronts. And that sort of typically still evens out, so that I like diversification. So I want to have a diversified portfolio, which means spreading myself out geographically to an extent. But then that's been the guiding force for a long time. But now when the world is maybe breaking in two, you don't want to be certainly 50-50 split, right? Because then you suddenly end up having half of your money on the wrong side of the new, what do you call it, the Iron Curtain, or the whatever is the Iron Curtain 2.0. And then you got to sort of, so there's a lot of sort of hard rules that can suddenly get smacked with another one, and then you have to balance them.
Yeah. So you just consider everything on a case by case basis and what's the most optimal at that time.
I respect standard academic approaches to risk management to some extent. And then there's some like we have the eToro risk framework as well that gives us like a score. And so I always try to be at a sensible score there. And so if I make any change to the portfolio, it has to be either good along to my own frameworks and eToro's frameworks. But there are a lot of stuff where, a lot of people, when they're trying to lower the risk in the portfolio, they'll look at historical betas, for instance. And because everybody's doing that, it becomes a very expensive way to try to reduce your risk. So then I don't do that. And then there will be other ways where here's a risk I don't think people are seeing. I can dodge that a little bit, and then I'm reducing my risk in a way that others haven't really noticed, and so I'm reducing my risk in a cheaper way. And that's the trick you have to, or that I want to do.
All right. And also on your portfolio, obviously, I noticed that you have the majority of stocks in your portfolio more than other allocations to commodities or crypto or other asset classes. I wanted to ask you why you think it's good for your portfolio to have mainly stocks and why you prefer stocks to other asset classes in your portfolio.
At a different level of prices, potentially I would prefer something different. But fundamentally, I want to own the assets in the world that I need for my own life, and that humans need for their life, right? We all need some products, we all need some services, we all need these things. And so if you don't own the companies that produce the things that you need, then you're really at a personal risk, because you're always reliant now on basically by paying whatever the price out is in the market. I'm very protected because I own a lot of companies, because if the price goes up a lot for something, it's okay, great, now I have to pay more as a consumer, but I'm making a lot of my companies that I own in this industry, so actually I'm quite well off, and then I can balance that out. Then there's certain things where you said, okay, we're going to need a lot of copper. A lot of my companies use copper now. We have one company that's recycling copper. We can solve some of the recycling. But how am I going to make sure that I can receive the products that need that copper? I can do that by also having some copper, but how can I have that copper at the right price? If I can have it, I can protect myself at a reasonable rate, right? But if it's too expensive, then I don't want to have it. But then if I compare, for instance, the copper mining companies and how much copper they have in reserves and how much they're producing and that cost of doing that with any other way I can invest in copper, I'm just like, it's just so much better to invest directly in the companies that way. And then you have something, I could hypothetically invest slightly more in real estate myself. But if I look at the amount of hassle that I have to go through to actually manage either a rental property or having even some people, they have very large property portfolios, but then they have several companies managing it, and then they have to manage the companies that are managing it, and then in the end, that becomes a full-time job. Then the fact that you can just go out there and buy a company that owns a lot of real estate and is renting that out and doing all that for you and only making a slightly lower return from that, and you're like, that's just way, way better. And yeah, hypothetically, if bonds were paying a really high interest rate compared to the inflation rates, then I would be investing a lot more in bonds. But for all the companies I invest in and all the companies I cover, I also look at what are the interest rates on their bonds, and they're just generally very terrible compared to how much I expect of profits from the best companies going forward. So there's just no way that those bond interest rates can compete with that. And then bonds might provide a more stable return over some years. I would rather than take, okay, my, say, company with a lot of hotels, they had losses during COVID. There's a big crisis, they'll lose some money, but then they'll have good years where they make a lot of money. If you average all of that out over 30 years, a really good total amount of money they'll have made. And then I'm happy to say, yeah, give me something where I don't get the same fixed interest rate every year. Instead, I sometimes get a lot of profits for the company, sometimes I get a lot, but when I average out a total way higher amount, and I'd rather take my money to buy the rights to receive that than the other. But it's not set in stone. I evaluated at the start of my investment career what kind of investor I wanted to be. And if hypothetically I had seen, okay, all the best investors that seem to have the highest return in the safest way possible, they're doing it in a different way, potentially I would have done it a different way. But I valued that fundamental analysis of companies, building a diversified portfolio of that is the way you get the highest return compared to the risk over the long term. And then that was the strategy that I went to focus on. If hypothetically, yeah, bonds just were paying way, way higher interest rates, yeah, then maybe I would. My last name is Bond, so maybe that would have been then that could have fit better. But yeah, I'm a firm believer now in stocks' future potential compared to any other asset class, really.
Yeah, I think they are very attractive in this type of market where we are in the global financial situation. Okay. And I also wanted to talk to you about the way that you do valuation models on particular stocks in your portfolio. I know that you have a background in doing valuations before you were an investor in your previous career. How do you go about actually evaluating the valuation of a company that you put into your portfolio? What's your process and what kind of models do you use?
Yeah, so there's a lot of stuff that happens automatically, which is just from all my data providers where all the data gets fed in. Then there is a lot of numbers that come in where it's my subjective reviews of stuff. How much do I like the CEO? How much do I like the new product? How much do I like all of this? So I assign numerical values to that, but that's still subjective. And the real key is sometimes being able to assign numbers to things that are very fluffy, to things that are very, and a lot of, I would say, bad investors and bad pundits and whatnot are they very much like talking about last quarter's earnings because this number is right there on black and white on the thing, but it's not the most relevant number necessarily for how they are going to perform in the long run. It's much more difficult to potentially say subjectively what you really like about TikTok compared to Reels, but that's much more important for how much money this company is going to make in the longer term. So being able to actually assign numerical values to subjective stuff and being able to hypothesize different futures in the world based off different things and then sort of think through what the numbers would then be based off of that. If you take an example, when I invested in Netflix back in the day, there were many people that understood tech that could say, okay, yeah, Netflix is pretty cool, but they didn't really understand what it should be worth. Okay, it's pretty cool. So should it cost 1 billion? Should it cost 100 billion? Should it cost a trillion? What? They have no clue. Then there's a lot of people in finance that know a lot about what things should cost, given a lot of assumptions, but they can't get those assumptions right at all. So they're just, Netflix, and they don't understand that's a better way of watching your entertainment in the future than what it was otherwise available at the time. And so neither of those managed to make that right investment. And so in that particular case, like, you got to put those two together and understand that this is the cool tech, and given that's the cool tech, it should cost this much. And if it doesn't cost that much, it's way cheaper than that, then you're buying some good tech here for a low price. Then there's other stuff like I would say my niche areas often where politics meets finance meets tech. A lot of people know two of those, but then they don't know the third one, and that's maybe where they get caught out. So they think that this is good because of those two, but then actually there's a third dimension there that makes it a bad investment, and then their portfolio gets polluted with some good stuff, but with a big component of that stuff that's bad for that other reason, and then in total the returns are just lower. Where the more you can take your portfolio and then get rid of some stuff because of this thing and get rid of some other stuff because of that thing and get a little bit more of that thing, the more you can add off of that, sort of the better a portfolio you will own. And then as you get into the future, if you just have a sort of a lot of, you can get a well diversified portfolio that's just delivering you the market average, and then all the actual great unique analysis you've added on top of that are what will make your portfolio have the potential for alpha.
Okay. So you really value both a quantitative and a qualitative approach to your investing.
I put quantity to the qualitative. Like, I don't like when some people, they have a phobia for numbers. They really don't like putting numbers and stuff. They'll be like, I think this is fabulous and I think this is amazing. I'm like, great. So which one is better than the other? So I'd much rather have, so which one is better on a scale from 1 to 10? Oh, but you can't. So, okay, why can't you say? Because they're multiple. Okay, then let's break it down. Okay, so this one has a better color, but this one has a bigger size, but this one has, what are the sort of qualitative factors to determine this? What are the numbers for that? And then we can start saying, okay, if this is important, we have a number here, then they can be, okay, we need a synergy factor here because these two kind of, if you have both, they're actually even better, and these two correct each other. If you have one, it's great, or if you have the other, it's great, but you have both, it sucks. You can have all this kind of different ways that different factors interact with one another. But at the end of the day, I wanna have all the subjective, all the qualitative turned into numbers that I can then work with, because then I can really say that this is better than that, that's better than that, this is better than that, under these conditions this is better than that. And yeah.
That makes a lot of sense, because you've got to be able to compare different investments against potentially different other investments, right? You've got to work out what's going to be the best for your portfolio in any given time. Okay. And how do you go about, obviously you have a long-term portfolio, that's your overall strategy. How do you go about taking profits, and how do you know in your mind when it's time to take profits on an investment, when to reinvest in different areas? How do you go about juggling your portfolio as the situation changes?
So I never think in terms of taking profits or cutting losses. Like, whether a position is in a profit or loss has zero impact on me. I never check like, oh, this stock has gone up a lot, now I have a lot of profits. Like, every day is day zero. What do I want to own right now? And then I want to own the assets that are the most valuable compared to the price. And then I answer that question. And to the extent my portfolio doesn't mirror that, then I make changes in portfolio for that. So it's not like there's no point of, if a stock has gone up a lot in price and the value has also gone up, it's like no different from an investment perspective. I have something that's twice as valuable, and it costs twice as much, so nothing's really changed. So what matters is if a company has gone up a lot in price without the valuation increasing a lot. That causes me to want to do a change, or vice versa. But other than that, I'm not really impacted by how positions performed in the past. I don't look at like price charts, what the price did in the past. I don't care if a stock came from up here to down here or came from down here up here. I care about what the price is today and what I think the company is worth based on how much profits they'll have in the future.
So you go into, when you're investing in a stock, you go into it with the mindset that you're going to be invested in it forever, unless the valuation is unattractive.
I buy it with the view of saying that this asset is worth a lot more than it costs. I don't go in with it with any sort of, if I have a horizon, yes, it's forever, because I'm valuing the company based off of, there are some companies where you're buying it, hypothetically you can have a company that's being wound down, or a company that has very few oil reserves left, for instance, where you really just, there's like a lifespan left on this company, and you're just buying it for that short term, they'll pay out that dividend for that while, you're getting it for that, and that's fine. The other companies will like, they are investing a lot, then they'll build more factories, then they'll reinvest that, and there's no expectation that they'll pay out dividends before many years in the future. And that's completely fine. Like, why would anybody bother to study to become a doctor? You're not going to get paid tomorrow for doing that. It's going to take many years before you start to earn back on that investment. Why would anybody pay into a pension fund when they're young? You won't see any return from that until you are 67 in Denmark and different ages in other countries. So that would make no sense, right? It's completely possible for someone to do something for a very long-term thing in mind. It's possible for someone to do something because that'll benefit their grandchildren far down the line. Someone to do something because you build a statue, that statue will be there for 1,000 years or something. You can, when I buy companies with that full-time horizon in mind, I like companies that deliver a lot of money tomorrow, but I also can value companies that will deliver money far, far in the future, or might not. There's a little chance that this technology will work out, and if it does work out, far from now, they'll make that much money. Okay, but I can multiply that up, I can give that a value, and I can decide based off of the price how that stacks up with that other thing. So do I rather want a company that can produce this much next year under these conditions, or this one that under these conditions can produce this much? They can all be calculated into what they're worth and compared with what the price is. And then tomorrow is a different day. If prices have changed dramatically or my valuation has changed, maybe there's some new thing in the world, the product that seemed like it was going to be successful tomorrow, we have it and we just see it's not, then I might get rid of it. But when I'm buying it, I'm never buying it with the idea that like, I'm buying this and then 6 months from now, if people will have bid it up and then I will sell it. I never do event-based investing. I don't do like, then I will buy this now and then in 3 months when people see this, then I will. That's not the point.
That's not your overall strategy. Yeah. Okay. And I have a hypothetical question for you now, a bit of fun. If you had to only have one stock in your portfolio for the next 50 years, what stock would you be most comfortable holding for that duration of time?
I'm not sure. The thing is that I can overthink that question, because when I'm then adding in risk to it, if I can only have one stock, I would want to have one stock that owns a lot of different things. So then you might have something like Berkshire Hathaway, or if depending on what else I have going on in my life, I could take one of the big like infrastructure company, something. But I don't have these in my portfolio because I don't need to have one big conglomerate that owns a little bit of everything. And if you're taking just one big conglomerate that owns a bit of everything, you're like, why not just take SP 500 then and say, why not just take a global index of something? If there's just like one company that I think can do incredibly well, that I would say, I'd be very, very sad to not have Nvidia in my portfolio, for instance, just because I wouldn't want to like close my eyes, wake up 20 years from now and then just seeing the whole things that AI has driven. Oh yeah, but what happened to Nvidia? Oh, I didn't pick that one. So I picked some.
Yeah. Now, the question was more based around what stock are you really confident in the most in the long-term future. Obviously, the situation changes over years.
Yeah, the thing is, I don't buy single companies based off of how confident I am in that single company. I'm very happy to have a company like TSMC, my biggest position, despite the massive geopolitical risk. Now, I'm also very happy to have companies that might do very poorly if the technology doesn't work out. I'm very happy to have companies that have some very significant risks to that particular company. But those risks are just not the same ones that are there for a lot of other companies. So then if there's suddenly world peace, some of my aerospace and defense stocks will not do very well. But in that case, then there's world peace. That's very nice. And then a lot of other things will be nice. And so there's a lot of companies that can have, there's this massive risk. So if you had it on your own, it would be terrible. But by having it together with this one, actually, it's completely fine. And that's my biggest position is TSMC, but I would be very sad to only have that one, because that just opens up a lot of potential scenarios for things going terrible, right? So then I think the easy answer would just be, if they just have to pick one, that would just be Berkshire Hathaway, because they have quite a lot of different businesses in that one company. But I don't have any Berkshire Hathaway in the portfolio now, and I certainly would not want to have it. So if I could only pick one, that one. But since I cannot, I don't want to have it.
Balances out the risk. Understand. All right, great. And in terms of people investing in your portfolio on eToro, what type of minimum timeframes do you recommend to copiers to copy your portfolio in order to get good long-term consistent results?
So in general, stock markets are very volatile compared to, for instance, bond investments or just holding your money in cash, earning a little bit of interest rate that maybe compensates you a bit for the inflation you're taking on. And so if you already know that you will need the money in 2 years for something, then probably copying me, which means investing in stocks, is not the right decision. I would generally say you should have at least a 5 year horizon. You can compare a little bit with in time horizon with buying a property. If you are not sure whether you'll be in 5 years from now, perhaps renting makes sense. At least that's for many people in many cases. But if you're going to live somewhere for more than 5 years and you qualify for a reasonable interest or whatnot, then potentially buying is the best decision. But you wouldn't want to be buying something if you're going to sell it next year. And you wouldn't want to be a little bit similar with stocks here, because you're paying a fee when you enter, although it's very small. You don't know if it's going to go up or down in the short term. Maybe in the long term, stocks on average have historically gone up. So zoomed in, the graph of stocks looks very much up and down, but zoomed out over a very long time, it's very just steady rise of through wars and crises and technological innovations, and somehow over the decades they just average out to a nice steady rise. But if you are quite sure, or there's a very reasonable chance you will need the money within 5 years, then probably copying me is not the right decision for most people.
Okay. So you would say like maybe a minimum of 5 years in order to be able to make sure that you're not obviously a casualty of volatility, which can happen in markets from year to year. Yeah.
Yeah, minimum 5, ideal forever.
Okay, great. And I know from your portfolio that you're quite into technology, and you mentioned yourself you're a bit of a technologist. Which particular areas of technology are you bullish on at the moment? Which do you think is going to make the biggest differences to mankind and everyday working life?
First, I'm less exposed to tech than, for instance, the SP 500. So many people, they think if they buy the SP 500, they're getting a sort of nice diversified portfolio. But you're only getting American companies. You're only getting the biggest ones, and they're primarily in tech. So that gives you much higher exposure to tech. But tech is my biggest industry, making up some 20 something percent of the portfolio. And then within tech, there are the platforms, but also the semiconductors and some of the device makers. And within those, I have a slightly bigger proportion in semiconductor space now, especially with the TSMC and some of their equipment manufacturers, and then the companies that are designing the chips for them. And yeah, I think that's probably the most interesting area within tech.
And are you quite interested in artificial intelligence and AI? Is it something that you keep track of for your portfolio? And also, what kind of changes do you think is going to happen in the everyday life and in the workplace through AI advancements?
AI is a very big component in my portfolio, both in that there are specific stocks that are picked very much because of their role in either creating or benefiting from AI, but it's across the whole portfolio. I have evaluated all companies, how the AI is going to influence them. I think that's the major thing we're going to see in the world. So when I value companies, how companies will be impacted in a scenario of different levels of AI going forward, that's hugely important to my valuation of any company. So if we have, then within that, I've been following like OpenAI since its very formation. Not many people know it, but their very first project was to make an artificial intelligence engine for Dota, the computer game. And then that was my favorite computer game, so I got in on it back then. Then when they made GPT-2, I was playing around with that, and then I just read the patch notes and really kept up to date on OpenAI all along. And when they made their partnership with Microsoft, I immediately ramped up my investments in Microsoft. And then even though I've had Nvidia since the beginning, at the beginning of the year, I ramped up further on that, and that just turned out really well. But because I started back in focusing in on that so much in 2017, I really managed to have a good head start. So it's been really nicely integrated into the portfolio as we've come through this. And then now, I continue to follow that space extremely closely, and potentially completely resettle if there's some new direction I'm sensing.
That's a good point, actually, Jeppe. AI has really come into the public consciousness over the last just few years, really, as we've sort of seen OpenAI and we've seen other applications of AI start to go into a bit more of the consumer mainstream. But as you said, it's actually the early parts of AI were actually established quite a long time ago. It's just now it's coming into that little bit more mainstream section of the life cycle of AI.
I think anybody who's watched my quarterly conference calls, they would have been well aware, because I've had one of my sort of main trends I've been highlighting there for all the years have been deep learning, and that's the basis of the great AI tools we see now. So it's been in my presentations all along, but I guess a lot of people just didn't really notice until lately.
Until it slaps them in the face. Yeah,
exactly.
And if we look at the macro picture of what's happening around the world, obviously we've had in 2022 and in 2023, we saw the increase of interest rates come on board to try and quell the inflation that was happening, which happened after COVID-19 and after the demand for products and services started to increase again. And we've seen interest rates at the moment hit a peak, which we haven't seen for a long time. How does it change for you in terms of investing in a higher than previously we had interest rate environment, and how does your approach change, and what are your overall views on the interest rates at the moment?
Firstly, if we put it in there's a book called History of Interest Rates, which sort of goes all the way, I think, to starting 8000 BC with I've hypothetically gone even further back. So what's the interest rate in the animal kingdom? Like a squirrel, how many of its nuts can it sort of regain when it saves it? What are other ways? I think for a lot of history back in the day, you actually did have a 0% interest rate. You were just expecting to give something to the village, and they'd give you the same back without getting anything. But if you look at in the past centuries, real interest rate have on average been about 5%. And so the real interest rate now is still lower than that. So while the interest rate is now higher than it has been in the most recent decades, it's lower than it has been historically, I would say. So that sort of puts in there that we can actually be fine with even higher interest rates on a sort of several year basis. Now, when you have high interest rates for an extended period of time, it changes how different kinds of companies are valued. Because you have some companies where if they need to spend many years really perfecting a technology and many years getting to the total market size to be there'll be 5 companies in this industry, they're going to be selling all over the world, they're going to need factories everywhere, and before they open in one new country every year, and then they do a joint venture here, and then it's just take a long time to build that whole business. And by the time that business is ready and finally paying a lot of dividends back to shareholders, it's going to take 20 years. So if you're paying a high interest rate for all of those years, that's money you're losing out on year after year after year. So that company becomes worth a lot less compared to one that already has all those factories in place in all those countries and already producing a nice free cash flow right now and handing that back to shareholders right now. And so their relative valuation changes a lot based off of the not just what the interest rate is now, but what is the expectation for the interest rate in the years going forward. And that's when interest rates went up and when expectations for them to go up more came in, it meant that a lot of, especially the companies that were growing a lot but were losing money, they went down a lot. And thankfully I foresaw that and got rid of most of those before that happened. And those valuations have come down a lot to reflect that. But those are really the companies that will not be giving you any money for a long time. They're really the ones that are, and especially if they also are highly indebted, so they'll be paying the high interest rates, and they don't know exactly when they're going to start making a sufficient amount of money, because they get the added drawbacks of uncertainty, where you become like, but then they'll need to raise more capital. What if they run out of money, or if they go bankrupt? And there's all these, you start to get all of these extra negative things around them that then start to detract a little bit from the valuation. And then, then those are some of the companies that are less, and yeah, if you see even higher interest rates, if we struggle to get that last bit of persistent inflation away, then that's going to be even more negative for those kind of companies. But then, of course, companies can also change themselves a little bit. So a smart CEO, knowing that he's now living in a higher interest rate environment, can say, okay, maybe we want to pay off a little bit of our debt instead of expanding that. Maybe we want to try to spend my management time on negotiating for some better costs with suppliers, and trying to see if we can get more out of our employees per dollar spent and so forth. Whereas if in a low interest rate environment, you might be more focused on saying, let's beat out the competition on a big marketing campaign or something like that. So if they are quick to adjust like that, they can soften the blow.
Yeah. Yeah, I agree with that. I guess it's companies that are unprofitable for long periods of time are the most affected by it. There's also smaller companies as well who have, it's more difficult for them to pay higher interest rates. They might not have the access to the capital that some of the larger companies have. And I think we have seen that with some of the smaller companies, and with the Russell 2000 has underperformed the Nasdaq and the S&P 500. Do you agree as well? It also affects the smaller companies.
There's there's other factors in terms of how easy it is to conduct banking and to conduct a lending business, and the fixed costs in those businesses have gone up quite a bit, and that really hurts small customers. If you've got to go through a big hurdle, like just anti-money laundering regulation, for instance, you've got to do that for every customer. That's just like a fixed cost you've got to do, and that's extra difficult if you have a small customer. So there's a lot of extra cost we've loaded onto the banking system that's hurting small businesses, and that's. But then you can also argue, then make a business bigger. If there's advantages and disadvantages of being a small business, and if all the advantages aren't being big, then become bigger. That's not always the case. Sometimes it's much better to be just a small independent company doing a few things really well for a few customers. And for other times, it's much better to scale up. And to the extent that there are big scale advantages for some of these things, then you've got to be better at it. And that can be different skill sets. Maybe some people are better at running a small business, but maybe then they need to learn the skills of running a bigger business if there is sufficient scale advantage to be reaped in that regard. And yes, and then there are different times. Like I prefer large companies to small companies. That's not a given. Like when 10 years ago, I preferred some smaller ones. But I think in some times of some disruption, there can be a case where these big companies now have so many things that will make them not able to respond to this. So they're gonna get killed by the smaller one growing. But there are other times where you're like, no, you can have this scale advantage when you're this big, and then the small guy can't get you. And then at that stage, you want to be the big one. So it's not a given that you should be small or big. It depends on the industry. And yeah, but yeah, banking and interest rate is something where there's been some extra fixed cost put in that's hurt small businesses.
Okay, so how well do you think that the Fed responded to the higher inflation? And do you think that it was when they were increasing the interest rates, do you think it was, would you deem it as being successful? And also, what do you expect moving forward? Obviously, we don't have a crystal ball, but are you expecting them to make interest rate cuts over the next 6 months or so? What's your viewpoint on that?
So first, it's always very easy to criticize what others did with your sense of hindsight, saying, certainly I would have done all the correct things, and them who were there at the time, they did all the wrong things. That's very, 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 very easy. I think a lot of different actors did some stupid things during COVID, and maybe the central bank also did something stupid in keeping the policy too loose for too long, even when some of the issues with pricing we were seeing were not only from supply shocks. And when there were supply shocks, those couldn't really be like solved with just loosening monetary policy. And then, but then that's if COVID had gotten even worse. At that time, you'd probably been really happy that they erred a bit on the side of keeping the monetary policy a little bit too loose. So it's easy in hindsight to say that they should have definitely started tightening earlier. But that's really, back then that certainly did not look as obvious. And then in terms of now, I think now it's not a given at all. I think this year we've slowly seen the amount of interest rate cuts expected has slowly fallen over time. So at the beginning of the year, people were saying we'll get 7 rate cuts, and then suddenly it's down to fewer and fewer, and now maybe 1 and maybe 0. I think if there's inflation and it's persistent and you really can't get that last bit down, then you cannot lower interest rates. And even if there is some, the economies are generally doing okay, like unemployment is under control, GDP is growing a little bit. So there isn't really a big case for why you should come in with looser monetary policy when there is still, you have some different targets in terms of unemployment and inflation, and you're okay on one, but you're not okay on the other. So the one you're not okay on is the one you got to target. And so then I think, and then you say, if we are in a position where we're wondering whether there'll be one cut or something like that, then certainly what we're really in is a degree of stability. We're just discussing the little bit of the direction around the stability, but we're not discussing that, oh no, they're going to need to come in and just ramp up the interest rate to 20% to finally kill this massive inflation like back in the day. And we're also not talking about, oh, there's all these things that are gonna collapse the economy now, or the economy is heading straight to a cliff and they'll need to. I think we are at a very economically average of times. So it's not that everything is amazing, and it's not that everything is terrible. People always feel like in retrospect, things felt geopolitically safe. And in the moment they feel geopolitically uncertain, like there's been this level of conflict for a long time. It's not like much higher or much lower than it has been historically. And the economy isn't looking much better or worse than it has historically. And we have an exciting technology. Quite often, actually, we do have an exciting technology coming up. Maybe this is a little bit more exciting with AI than the average one, but I think it's a good average time to be an investor.
I think inflation doesn't just go in patterns, right? It doesn't just keep falling and it doesn't go up without changing the pattern. And I think with inflation, it can be quite sticky and it can change over time depending on the geopolitical issues and what it may happen. I guess they just have to pay as close attention to the data as possible and make the decisions that they think is best. And it could come to the point where they do cut rates and they could undershoot inflation and it could potentially go below the target as well. That's also a potential scenario.
Indeed.
Yeah. Okay, and I wanted to ask you as well about some of the shipping rates actually. So the shipping rates are starting to increase. I guess a lot of that is to do with the geopolitical issues between obviously Israel and Palestine. Cost of oil has been quite high as well this year. Have you started to see any effects on any of the businesses that you're invested in terms of the increased shipping rates? And do you think that they could have an effect on your businesses in your portfolio in the future?
The biggest, these are security on the seas and the oil price and so forth are of course important. There's Danish company M.Sc are also exploring some alternative fuels that look interesting. In general, we have a big problem with the shipping business with the sort of a global decoupling. I think a lot you are changing from a world where the key to deciding where to have your big factories that there are a lot of cheap laborers available to we just want to have a few really smart engineers, and where can we find a really few smart engineers? That's potentially in some different locations. And then if you are going to have your big factory right in America, right next to where there is a train and right next to where there's good roads and so forth, then potentially you will not be shipping as much. And then you have lots of commodities that then don't need as much shipping, and then potential that means for our world. And those are consumption patterns. The more we are spending our life digitally, potentially we need fewer products. So all of that sort of puts that it's not necessarily the greatest long-term future for shipping, I think. And then there's also sort of the actual building of the ships. I think there's been built too many ships, and that's of course also you got with a lot of industries. You have the same in the semiconductor space as well, and in mining as well. That it takes a long time for a project to come online. And if it's online, you don't really turn it off that easily. If we build a new foundry to produce a lot of semiconductors, we really want to be using that all the time. If we build a ship, we want to be sailing that ship, right? If we open up a big mine, we are going to be mining. So it's very easy to increase the supply, but it's very difficult to remove it again. So you really got to, as an industry, be sure that you are forecasting correctly and you're not being too optimistic and having everybody going out trying to mine more copper at the same time or build more ships at the same time, and then suddenly finding yourself with lower demand than expected and an oversupply, and then all of you really are killing yourself in that way.
Okay. And in terms of investing in different geographical areas, how do you see at the moment investing and valuations in terms of international markets and non-US markets? If we look at Europe, we look at Asia, I think the valuations are lower. Obviously, the potential growth is also lower as well. How do you see the differences, and how do you approach investing in international markets that aren't the US?
So firstly, I look at many different companies in many different countries, but I don't look at, I don't like try, I don't do this top down version where I'm like, ooh, on average, Japanese stocks are cheap. Let me look more at Japanese stocks. Like that's if Japanese companies, some of them might be very expensive, some of them very cheap. I don't care what they are in total. I'm not going to buy all of them anyway. So I'm very happy to have a country where 99% of the companies are trash. If one of them is good, well, that's the one I'm going to buy. So I don't care how there are many averages in the world that are important to me, but how cheap or expensive stocks on average are in any single country, I don't care about at all. It's just not like that. I don't do that sort of identify one industry and then let me look into this industry or something. I slice and dice across many different industries and companies, and then I might have ending up knowing most of the companies in an industry, but it's not based off of coming from what's the average in this industry, what's the average in this country. Then there are some countries where I end up having a lot more investments for some of the country specific factors. So I have a lot of companies in the US and I don't have many in China, and that's for, I think America is a very safe place for me to have a lot of my money invested in a lot of different scenarios, even some very bad ones. Potentially, my American companies are the ones that will still be very good for me. Whereas in some very negative scenarios, potentially, same that I saw with my Russian company that I basically lost because of the war with Ukraine. That could happen with some of my Chinese assets. So I don't want to have too many Chinese companies for that reason. And that affects all of them. But so that also means that you could say, yeah, on average, I can see that the Chinese companies are cheap on some multiples or something. But that's like cheap compared to what? Compared to the profits they made last year? Yeah, but what if they'll pay me nothing in 3 years? Often also at maybe one terrible way to be an investor, but that's very popular, is to use screeners where you just start with all of the companies and say, I want companies that are profitable. Then they should have good growth. Then they should be, I want from these countries. And then you end up with a company that fulfills all of your criteria. And you think, oh, this lives up to all my criteria. This must be great. And then you invest in this one. But what you don't know is like, why is this one cheap and why does this one fulfill all of your ticks? Because there is another tick. Like it meets your 10 ticks, but there's an 11th that's so terrible. That's why you shouldn't invest. Like they are these 10, oh yeah, but the CEO is cheating the company. They're lying to you about the numbers, or they have a huge lawsuit coming that's going to wipe them out, or there's some other thing that wasn't in there. And so you really want to come in from the other side. And then if you found it and it's great for these things, then you can make it, then you can go through a much, much longer list of things.
Wider decision based on lots of different criteria and different factors, right?
But this top-down approach of like screening yourself, and it really, in practice, selects out companies that have some other terrible thing with them, and you just don't know what that thing is. And now you are. So yeah, that's very popular to just look at big average and then zoom in that way, and it leads to a negative alpha.
So I noticed you're invested in Taiwan Semiconductors company. And did you have any concerns when investing in that about potential conflicts between Taiwan and China? Was it a factor that you considered? Did you consider it low probability? And just talk to me about that process.
My job is to be a professional worrier, so I worry about these things every day, and I keep up to date on it every day, and I change my analysis every day, and work through any kind of new crazy scenario I can concoct. If this happens at the same time as this, what if that happens with that? How if it went this way instead? What if even stuff that wouldn't happen, but just for the fun of it, and to see does that yield off any other crazy ideas? And for each of those things, it's not important to me how one company in the portfolio would do. It's important to me how my whole portfolio would do. So I'm very happy to have companies that would do absolutely terrible under these conditions. If under those conditions, then some other ones would do fine. And then even there can be some scenarios that are very unlikely. It was like, yeah, but what if this did happen? Then probably I would do very poorly on these ones, but I would do okay on these ones. And so total, my losses would only be this instead of being that. And then I can live with that. And it's very intuitive. Anybody who's studied finance has been drilled through that, and it's probably the most difficult one to understand is the difference between the systematic risk and the specific risk. Because most people that are not familiar with finance, they really focus on the specific risks, which are the risks that are really special for each company. So they said, aren't you worried about this thing with that company? But if that risk is unique to that company and your other companies don't have that risk, then it's if you flip a coin 100 times, if you flip a coin once, it might be like heads or tails, very risky. But if you like 100 times, probably you'll have between 40 and 60 heads or tails, and you're not going to have 99 one. And that's the same. If you have a lot of companies that each have those individual risks, those risks cancel each other out. Yeah, maybe that CEO will get sick, but then this other guy didn't get sick, or this CEO is going to die, but then this CEO didn't die, and then this product is going to sick, but this product, and then all that stuff averages out, and then what's left is all the stuff that's really risk-wise is what affects the whole portfolio, and where you can't really find a way of diversifying out, saying like if a comet strikes and destroys all of Earth, that's the entire portfolio gone. And you can't really diversify with it. Maybe go to space, that would be great, but yeah, short term difficult.
Yeah, that's why diversification is so important, because you can have issues like they had in Russia. You can have potential conflicts with Taiwan and China, and your portfolio should still be okay because of the other elements within your portfolio. Okay, thanks, Jeppe. And how can people find out more about you? Which avenues can they find out more about you and more about your work?
You can either watch some of my videos on YouTube or add me on LinkedIn, or just go on eToro. And then once you're on eToro with a demo profile, probably you'll come across my name somewhere on eToro.
Great. And I'll drop all of the links in the description of the video so people can find out some more about you. Thank you very much for the discussion today. I think the audience will get a lot out of the discussion. And thank you very much for joining and for your time.
Thank you.
Thanks, Jeppe.